Welcome to today's class. As I mentioned, today's class is on savings and debt. So I'm your teacher. My name is Michael. I'm basically trying something new with Growzania, where we're trying to build a community of like-minded people who are looking to grow and better themselves. So very excited and happy that you're here with us. If you were there last week and you've been there for the webinars as well, thank you very much for the support. We also actually have one tomorrow. So in case you've not registered, you can check on our website and you will see the event that we have running tomorrow. So last week, we went through the fundamentals. We spoke about time value of money. We spoke about the importance of compounding interest. We talked about the power of starting early. And then we also talked a bit about budgeting and why it's important, and that it's the first step for you to get on your journey of financial wellness. So today we'll be talking about savings and debt. So in savings, we'll talk about a few things. We'll talk about how you earn more than you spend. We'll talk about tools that you can use to save. And lastly, we'll talk about why it is important to start early. In terms of debt, we'll talk about building and controlling debt. We'll talk about how strategic uses of debt, steps that you can use to control debt. And then we'll look at three forms of debt in detail. We'll look at credit cards, we'll look at mortgages, and we'll look at car loans. And then for next week, just as a highlight, next week is where we'll be talking about investment. We'll talk about a bit of stocks, the money market, we'll talk about balance funds, and we'll talk about the power of starting early, all of it as in the bit of debt. So to start off, again, same house rules that we had before, nothing has really changed. So this question is all for you. So feel free to stop me in case something is not clear. Feel free to ask questions. Let us be as interactive as possible, and let's get to know each other. And as much as possible, if somebody feels comfortable to share an example in the class, please let's not use that as something to shame them in future, because we want it to be a safe environment for everyone. Then, let's also get to know each other. So just as a quick way of intro, I'd like us to answer these two quick questions. I'm hoping you can see them on the screen. So the first question is, what is the one thing that you would spend money on if you had all the money in the world? And then secondly is, what would you do with your time if you didn't have to worry about money? So I know they're very strange questions, and I'll explain to you why I selected those two. So I would like us just to have a go at answering them. Today, I'll start from the bottom of the list rather than at the top. So I'll start with Stacy. So maybe just unmute yourself and you can answer these two questions.
My answer for number one, I would spend on real estate.
Yes.
And then if I had all the time, I will travel the whole world.
Okay. So the first one, you said the one thing you'd spend money on is real estate. So I'm assuming this would be like buying houses for you to live in or for investment?
Yes, for both.
Okay. And then the second one you said was you would travel the world, right?
Yes.
Okay. Caroline, if you're there, we're answering these two questions on the screen. So what's the one thing you'd spend if you had all the money in the world, and what would you do with your time if you didn't have to worry about money? Okay, so it looks like for today we don't have a lot of people who are able to speak, but the reason why I was asking this two questions is for two reasons. So first is, in last week's session, we spoke about the importance of setting financial goals, and that your financial goals will really help you to really achieve to be able to start on the journey. And it does take time for you to achieve your financial goals. So these two questions are really meant to help us set what we want our financial goals to be. And once we know what those are, then we now start off on the journey to be able to achieve them. So that was the purpose for those two questions. And that's the reason why I put them up, and I would have loved if we all answered. So for today's session, as I mentioned, we'll go through savings and then we'll go through building and controlling debt. So in terms of savings, we'll talk about how you can to make sure that you earn more than you spend so that you can have money to save. We'll talk about tools that you can use for saving. I think that was a popular question from last time. And we'll also talk about the importance of starting early in your saving journey. So when we start off on saving, so the first and important thing is that you should not save what is left after you spend. You should actually spend what is left after saving. And I know it's a bit hard, especially when you're starting off, but it's important to set yourself a goal to start with it, no matter how small an amount, and then aim to increase it over time. And that's why saving is actually called as it's actually called deferring consumption. So what that means is that rather than taking money today for you to spend it, you actually say, I'm going to keep this money and I will spend it later. So later could mean after it's grown to something else, or after you've saved a good chunk for you to then be able to to spend. So why should we really save money? Why is it important? So we did speak about last week that the future is actually very uncertain. You can control your spending, you can control your investment today, but you cannot control what happens to your income in the future. So savings usually come in handy for rainy days. And then secondly is that saving gives you freedom to do what you want whenever you want it. Saving enables us to be able to be free financially. You don't have to really think about um, every time you want to finance something, you don't really have to think so hard about it. And even when you're doing big purchases that you wouldn't be able to pay from your 1 month or 2 months paycheck, you know, if you do save and plan it out, you can be able to afford it. So this could be things like homes, could be a car, could be a vacation, and could be others big purchases that you're looking to achieve without necessarily borrowing the money. So in terms of savings, how do we divide up savings? So savings can be divided into two. So you would have basically current savings, and then you'd have long-term savings. Then in current savings, you can have two types of current savings. You can have an emergency fund, and you can have a screw you fund. And I'll explain to you what each of them is. And then you could have a happiness fund or a retirement fund. So in terms of an emergency fund, so this would be basically for rainy days. We do know that for lack of better words and from the little French that I know, we do know that shit happens. And this could mean there could be health issues, whether for yourself or for your family. You know, there could be a death and you need to be able to finance the funeral. You know, if you own a car, accidents happen, tires burst, and those kind of things. And the emergency fund would basically be able to achieve that. So your emergency fund is basically like 1 month to 2 months of your expenses, and just put aside for a rainy day because you're not really sure when a rainy day will happen. Then in terms of a screw you fund, so a screw you fund is basically 3 to 6 months worth of living expenses. And this is for just in case your employer decides to reduce the number of people they're paying, just in case you do get something like a pay cut, which you've recently have seen happening right now during the COVID times. And therefore, this screw you fund would really help you to be able to cater for your living expenses should anything happen. Then for a happiness fund, this would be basically just for you to be able to afford big items that you're looking to afford. So this can be stuff like, you know, if you want to do a vacation, you could decide to save up for it. If you want to buy a house, if you want to buy a car, you know, any other dreams that you'd like to achieve, like a master's, a PhD, some people do finance them by saving up to be able to achieve the target. Then in terms of a retirement fund, this is basically, don't think about it as the old age form of retirement. This is basically just a fund to enable you to do what you want when you want. So some people do put aside money for a retirement fund and say, when I get to 40, I want to be able to take a career break, maybe 6 months, 1 year, before I decide what to do next with my life. So a retirement fund could really help you to achieve something like that. So once we know what types of savings there are, so how much is enough for you to save? So there's a simple rule that's usually known as a 50-30-20 rule. And this is what largely we spoke about in a lot more detail. But in terms of spending, you should spend 50% of your money on your needs, which would be basically clothing, housing, shelter, 30% on wants. So wants, you can be able to define what are wants for you. Could be clothing, could be buying new shoes, new handbags, depending on who you are. But then you should also put aside about 20% for savings. And then the question I know that many of you who are in last week's class will ask will be, but we did say that you should save 10%. So why are we now talking about 20? So the reason is, the 10% is also a very low number for you to start with. But over time, if you're able to increase it to 20, then you'd be in a much better space than if you just saved 10%. And also remember from what we spoke about in the power of compound interest, the more you save, the more interest you earn. So if you do put aside more money for saving, you'll be able to achieve a lot more. However, if you do not put aside a lot for saving, then you'll really struggle in terms of being able to achieve what your goals are. And then I just wanted to share with you some shocking data here. So only 1 in every 10 Kenyans has any form of savings. So doesn't mean that they have 1 million or 10 million or 100 million saved. So, even if somebody has 1,000 shilling in savings, so it's only 1 in 10 people who have any form of saving. And when they were asked, why is it that they can't save? So 40% say that they can't save because they don't have the money to save, which is a fair form of answer. And then another 42% say that they are not able to save because they don't have a regular income. But I really want to challenge you not to be in this box that thinks that you really have to get a regular income or you have to be able to have a lot for you to save. I really want to challenge you, even if you can put aside 5, 10, 20, whatever amount that you can put aside, do start putting aside money for you to save today. And it will really help you and really come a long way in terms of helping you achieve your goals in the long term. So really get started on the journey, the sooner the better, and don't really fuss about how much you're putting aside, whether it's 10 or 20. Just put aside something for a start, and over time, this will then grow to something bigger. And apologies, I can see the screen has gone for a bit. I'm just trying to fix that. Then we should be able to continue. Okay, so hoping the screen is back now and you can be able to see my screen. Okay, so let's talk about tools that you can use to save. So this used to be the old ways of saving, but I still see a lot of people using them in one way or another for saving. So people still put money under the mattress. People still use cookie jars and piggy banks. I do see them in the streets being sold, so I'm assuming that there's a market for that. And some people also have safes in their house where they put money and those kind of things. But other than these 3 places to save, there's a lot more places where you can put money for you to save. So a good example is you could have a bank account, and this could include other places like SACCOs and chamas where you hold an account and you place money to save. You could use pooled funds. So I'll explain to you what pooled funds are, but these are examples of money market funds, balance funds, and mutual funds or unit trusts. And then you could also save money by buying treasury bills and treasury bonds. So I just wanted quickly, just based on your thoughts, if you were to rate these 3 methods in terms of the ease of access to funds, the security of the money that you put, and the return on investment. So which one would you say has the highest return on investment? Which one has the highest security of your money, meaning that you're less likely to lose? And which one is it easier for you to access the money when you need it? So, I mean, anybody who wants to give a try, please go ahead. Just trying to rate these 3 methods based on those 3 criteria down there. So which one do you think is the safest? Which one do you think has the highest return? And which one is is easiest for you to access your money. Okay, and while we're waiting for somebody to answer that, I can see, Caroline, you said, I guess this was the answer to the first question, what you do with your time. If you didn't have to worry about money, you're saying that you would love to help the less privileged in the society. That's brilliant as well. Thank you for that. Okay, so any thoughts on these three methods? Which one is easiest to access funds? Which one is most secure? Which one has the highest return on investment? There's no right or wrong answer, guys. Just give it a try.
Can I try?
Okay, looks like nobody wants to try. So we'll just proceed and I'll help you answer the question. So in terms of bank accounts, so what happens when you have a bank account? So as I mentioned, this also includes if you hold an account with a SACCO or with a chama. So usually what happens is you put money into a savings account. If it's in a bank, most of the time you get a really bad interest rate. This is because the bank uses your money to loan out and to invest. So they really can't give you a high interest because they also have to make money for themselves. And then in terms of ease of accessing the cash, so in most cases, you can be able to access the cash if you have it in a bank account. But then for chamas and SACCOs, sometimes they do not allow you to withdraw your savings. What happens is they require you to sell out your money to other chama or other SACCO members. And then, in most cases, if you save in one of these three, your money is usually secure, but then you just need to be a bit more careful. So we do know, stuff has happened in Chase Bank, in Imperial Bank, and, stuff could happen tomorrow in any other bank or in any other SACCO. So it's just important for us to be careful. So in terms of what each of them is, so just looking at specifically banks, ease of access of funds is very high. You can be able to withdraw at any time you want. Of course, for SACCOs and chamas, it might be a bit more difficult. In terms of how secure your funds are, most of the time it's pretty secure unless your chama has a bit of dodgy people. But in most cases, the funds are usually secure. And then in terms of return on investment, it's not very high, except in SACCOs where you do have some SACCOs that offer very high interest. But then in most cases, the return on investment is not usually as good for banks and chamas. Then in terms of pooled funds, so what are pooled funds? So the two that I really wanted us to go through today are money markets and balance funds. So for money markets, so these are just basically where different people put money. So I myself as Michael, I put money, someone else puts money and all that. And then what happens is the investor or the investment manager then takes the money that we've all put together and goes and buys high quality short-term instruments. So what we mean by high quality short-term instruments is that they're high quality in terms of it's very hard for the money to actually get lost. For example, if you save in cash, if they use it to buy cash, like to buy Forex and stuff, or if they invest in like treasury bills and bonds, then it's the risk is really low. And then what they do is they then take about 2 to 3% of what they've invested. So if they invest and they make 10% interest, then they take out about 2 to 3. So they pay you, if it's in the case of 3%, they pay you about 7%, and then the rest becomes their fee for managing the fund. So in terms of a risk, these are usually very low risk, and your capital or your principal is usually guaranteed. And in terms of what our thoughts are, so this is usually very good for short-term savings, because the cash can usually be accessed within about 2 to 4 working days. So if you do write an email to them and say, I would like to withdraw 10,000 bob, then within about 2 to 4 days, they will send the money to your account. Then in terms of balanced funds, so balanced funds as well are pretty much like money markets, where different people bring money and pool their money together. And then what happens is they then take this money and they buy low risk assets. So they buy stocks, they buy bonds, they buy treasury bills, and they do that in a mix. And then from there, what happens is they take the same 2 to 3% of their management fee from what they're doing. So in terms of a risk, this is usually low to medium risk, and then your capital or your principal is not guaranteed in this case. So it has a bit higher risk, but of course also the reward is a bit higher. And in next week's class, we'll talk about the risk-reward ratio in a bit more detail, where we'll be able to see, why one would be better than the other and why the risk is versus the reward is higher in some savings or investment ways. So in terms of what you should use balance funds for, so if you're looking for medium to long-term savings, so if you're looking to save up for 2 to 5 years, then these are usually very good because you kind of ride the wave of stocks rising and getting low, and you kind of also get some benefit from the fact that your money appreciates just as a result of the stocks appreciating in value and all that. And then on the other hand, money markets are good for short term. So if you're looking to draw your money within 1 year to 2 years, then of course money markets would be the place. So in terms of using them for savings, and why I've really called them out for savings is because you can also use this for investment, but here we're talking about using them for savings. So usually the interest rate is 2 to 3% lower than treasury bills and bonds, and that's what I mentioned is the asset manager's fee. And most of them give out after the 2 to 3%, then they leave you between 8 to 10% interest annually. And then how easy is it to access cash? In most cases, you can access your money within 2 to 4 working days, give or take. And then your funds are usually secure, but again, due diligence is very important. A good example is a headline I've put there from the Business Daily of October 26th, where one of the balance funds that was run by a company called Amana actually shrunk the investors' assets by about 85%. So meaning people lost a really, really huge chunk of money. So you really need to make sure that you're investing in the right place. And usually if you invest with big companies with a lot of experience, examples would be the likes of CIC, Sanlam, then your money is a lot more secure than if you go into smaller companies that are less experienced and just getting to start out. Then in terms of treasury bills and bonds, so what are treasury bills? Treasury bills are basically short-term government debts that mature in a year or less. They're usually low risk, and this is because they're guaranteed by the central bank. So it's basically you're loaning your money out to the government, and they use it to pay their expenses, and then after a short term, maybe could be 3, 6, or 3 months, 6 months, or 1 year, they pay you back your money plus the interest that is owed to you. In terms of treasury bonds, these again are similar to treasury bills, but usually now much longer period of about 5 to 30 years. You don't have to be in for the 5 or for the 30 years. There's what they call a secondary market, where you can sell after you buy the bond. You can be able to sell it on the secondary market. That and you get back your money and get out of the bond. So in terms of risk for both treasury bills and bonds, it's very low risk. This is because they are guaranteed by the central bank, and it doesn't matter whether the government changes hands. You will still, you'll still get your money and the payments that are due to you. There's nothing that will happen to your money, even if Uhuru stops being the president and somebody else takes over. In terms of what our thoughts are, so specifically for treasury bonds, for treasury bills, these are usually good for short-term savings. Again, if you're looking to withdraw your money within 3 months or 1 year, they're pretty good. However, if you're looking to sell in an emergency, it's not usually very easy. So it takes about 7 to 14 days for you to get your money. So slightly more than what you'd work with if you are saving in, say, a money market or a bank account. But if you can be able to manage your cash flow well, it would be a very good saving tactic. of treasury bonds are great for medium to long-term savings, and they give you interest and compared to go on to the next one. I just want to check that we are all able to talk. You can just type on the chat box, say yes, we are together, just to make sure that I am not losing anyone. And in case there's any question as well, feel free to post it in the box. Okay, so Sarah, you're saying you're requesting for me to share the slides. I will do that. I will also send through the recording so that you can also follow the class. I'll do that. Okay, so I'm hoping we are all together. I've only heard from Sarah and Caroline. So Genevieve, you're saying we're together. Thank you. And again, in case of any questions, please feel free to ask. And then Simon, you're saying you're following as well. So thank you. So in terms of how to use treasury bills and bonds, again, specifically for saving, because you can also use them for investment. So in terms of interest rate, if you take a short-term treasury bill of about 3 months, you'll get about 6.6% interest rate. And if it's a longer term one, one, for example, that goes all the way till 25 years, you get about 13.9 or 14% interest. In terms of how easy it is to access your cash, so bonds can usually be sold in the secondary market, as I mentioned, and this enables you to access your cash, but this can take about 5 to 15 working days, which is slightly longer than the money markets that we were chatting about earlier. And in terms of how secure your funds are, so your funds are very secure if you buy treasury bills and treasury bonds. And even if the government changes hands, your funds will still be safe. So I think in terms of those three that we've spoken about, we spoke about bank accounts, which can also include chamas and SACCOs. We've spoken about pooled funds, which are, for example, money markets, and we've spoken about treasury bills and bonds. And then the question would be, where should you really put your money? So I think one of the questions that was asked last week was about tax, which is the first one, and then the second one is where should you put your money? Right, if you had some money you wanted to start saving right now. So in terms of bank accounts and pooled funds, so you're charged about 15% of your interest income, and we'll use an example to illustrate, how much tax you pay in if you were to save in a bank account or in a money market fund. And then in terms of treasury bills and bonds, it's about 10% for bonds with a longer maturity of about 15 years. If the bond is maturing in less than 15 years, you pay about 15% of tax. And then there's special bonds that the government gives that are called infrastructure bonds. They usually have slightly lower interest rate, but then you also don't pay tax on it. So the tax on infrastructure bonds is usually zero. But of course, the return on the investment is slightly lower than the other normal treasury bonds. So just to illustrate as an example, this is a lady that we call Jen. She's about 21 years old. She's determined to save. She saves about 100,000. She has about 100,000 that she's saved in her money market account. So what you find is that her savings is 100,000. If we assume that the interest that she's earning, which is what actually is in the market roughly right now, so she gets interest of about 9.7% on her money within 1 year. So at the end of 1 year, her money becomes 109,700 shillings. And then, after tax, so the tax is about 15% of the interest. So her principal, which is 100K, is not taxed, only the interest is taxed. So the tax is 15% of the 9,700. So she pays 1,455 shillings in interest. And then after tax, basically she remains with 108,245 shillings, which is about an 8.25% post-tax rate. So if you can see here, so before tax, the rate that she's earning on her savings is about 9.7, and after tax, the rate that she's earning is about 8.25. So that's just as an example. And the reason why I use money market as an example is because I think it's a good place to save money, just for a few reasons. Number one, it's easy to access your money. Number two, your money is safe. You can never lose. In this example, you won't lose the 100K. You can, in a bad year, they could say they're not able to give you interest, but you cannot lose your 100,000 that you saved with them. And then the other thing is, in terms of if you want to access the cash, you can access it within 3 to 4 working days, which is usually acceptable in most cases. If it's an emergency, you can write to them today, and by by Thursday or Friday, today being Tuesday, you'll be able to get the money into your account. So it's a pretty solid place to put your money, and you can always top up on a weekly, on a daily, depending on how much you want to save. And I think the minimum in most cases usually are 500 shillings. So if you have 500, you can be able to top up via M-Pesa, via any other method, and just keep your account running and keep the saving culture going. So I think that's that for saving. Then in terms of the power of starting early in saving, I think we spoke about this last week. Compound interest is really powerful. If you understand it, you will earn a lot. And if you don't, you will end up paying a lot in terms of compound interest. So if you remember, we had these two ladies last week that we went through. So we had Jane, who's about 21. She gets her first job, saves about 20K per year for 10 years. And then when she gets to 31, she stops saving, but she lets her money sit in the saving account until she's 55. And then on the other hand, we have Joy, who's about 21. She gets her first job, decides to wait until later to start saving. And then when she gets to 35, she realizes that she's getting old and she's starting to retire. And then she starts saving about 20K per year till she becomes 55 years old. So in this particular case, not showing using the same thing that we had last week, but you can just basically see for Jane, who started saving early, she only saved 200,000 of her own money, but because of compound interest, she was able to get to about 2.6 million by the time she got to the age of 55. And then on the other side, we have Joy, who saved about 500,000 shillings of her own money because she started late. She started at the age of 35. And compound interest only got her to about 1.7. So you can see the power of starting early, and even for saving, the earlier you can start, the better for everyone. So start early. That's why I insist, if you can be able to put aside 500 shillings, 1,000 shillings today, start with that. Then challenge yourself to grow it to 10, to 20, to 30. And over time, you will see the power of compound interest really working for you. So in terms of a summary for the savings section, so make sure that you can be able to save at least 20% of your income. I know it's a steep one, especially if you're saving zero today, but start with something and then slowly move it to 20% of your income as your income grows and as your wisdom also grows. And then in terms of tools that you can use for saving, consider money market as a good tool for saving. They have great return on investment, and it's easy to access the money in case you need it. And make sure you start saving early. There's no better time to start saving than today. So start today to save. Okay, so just checking how we are doing. I can see Ruth saying that internet coverage is not the best. So yes, I will send through a recording of the class just for you as well. I will also send through the slides this week's slides and last week's slides as well, so that you can be able to catch up on the bits that you may have missed. So just checking that we are together. If you can please type just a quick hi, quick yes if we're together. And then in case there's any question, please also feel free to leave a question in the chat box or unmute and answer it. And ask your question, and I will be sure to answer it as we go. Okay. So I can see two people saying they're following. I guess we'll continue. And in case of any question, please feel free to stop me and ask at any point. So the second bit and the last one for today is about building and
Excuse me,
contributing.
Sabri.
Yes.
I would like you to illustrate more on treasury bills and bonds. Haven't understood well.
Okay. So coming back to treasury bills and bonds. So what happens is the government usually puts out money for puts out it's basically loaning your money to the government. So the government says we need to be able to fund roads, we need to fund other projects that they are doing, if they're building schools, if they're spending on education. So they say let's get money from domestic people, investors, and then use that money to spend on the roads and those other kind of things. So that's what a treasury bond or a treasury bill is in its in its simplest form. So what happens is does the government do that? So they say we want to collect 1 billion shillings to fund maybe the construction of X road. So investors then who have accounts with the central bank and who are interested in investing, they then apply. So out of the 1 billion, you say, I'm willing to give my 10,000. Somebody else is willing to give their 100,000. Somebody else is willing to give their 1 million. And then the government usually publishes for each bond. If you go to the central bank website, you'll be able to see what they call a coupon rate, which is just basically the interest rate. So they'll say, for this bond, we are willing to give an interest rate of X%, which usually ranges from 6% for a 3-month treasury bill and about 14% for a 25-year treasury bond. And then, once you give your money, then the central bank just basically pulls the different money they've gotten from different people. Then they give it to the government, and then the government basically pays you back your money in small bits, depending on the way the bond is structured. So in some cases, they pay you the interest on a half yearly basis. So every 6 months they could pay you, if you've given to them 100,000 and the interest rate is 10%, so that's about 10K of interest per year. So if you divide the 10K by 2, it becomes 5,000. So they pay you 5,000 in June. If say the bond was a January bond, so they pay you 5K in June, and then they pay you 5K in December. So basically, that's just an example of how a bond would work. And then if it's a 5-year bond, when it switches to the 5th year, they then pay you your 100,000 shillings back plus the interest that's due to you for that final period, which would be the 5K. So you'd get 100 plus 5,000. So the total payments would be the interest that they paid you in bits over the time, together with the final payment that they pay you at the very end, which would be giving you back your 100,000 shillings. So I don't know if that's a bit clearer, Genevieve, in terms of treasury bills and bonds.
It's very clear. Thank you.
Okay. I think the other bit is I mentioned what is called a secondary market. So if today the government issues a treasury bill or a treasury bond, if you don't want to wait for the payments as they are meant to come, then you can then go to the central bank and ask to sell your treasury bill or the treasury bond, and they will then place it for sale to potential investors, and you will get your money back. It's kind of like exiting the contract before the actual time period is done. So that's how it works. And then it's usually used a lot by banks and money market funds. So they pull investors funds. So like if you put your money in your bank account, the bank takes your money, goes to the central bank, buys a treasury bill or a treasury bond, and they then wait for the payments that are due to them, which becomes, of course, income to the bank or to the money market fund. Okay.
Okay, thank you.
Anybody else with a question? Um, I can see Mutavute, you've unmuted. I don't know if you had a question. Okay, I can see Simon has asked a question. Which one is better for long-term returns? Is it investing or purchasing, for example, land, or saving the same amount in the pooled funds, for example? So I think that's a bit of a tough one, because especially for land, it really depends on the place that you actually bought and the value that comes out of the land. So if you bought land in a very secluded place, development will take a long while to come to the place. Then of course it's going to take long before your land appreciates in value. But if you bought land in a place where it's really developing fast, the town is really growing, roads are coming, and those kind of investments, of course the land will appreciate much faster. But in last week's class, we did go through the importance of evaluating land as an investment method versus these other investment methods. You could easily find an example where you invest money in land, but actually whatever you get back as an interest as a result of the land appreciating is much lower than if you put the money in, say, for example, a money market fund, and you got your 8 point something percent after tax as an interest rate. So it's really important to evaluate both. I would say, for me, I would really say it depends on what the true reason you're saving is. So remember, if you buy land and you're saving, say for example, for your emergency fund, it's very hard for you to sell land. You can't sell land within a day or two. But if you put the 500,000, say for example, in a money market fund and you needed to access it, you can easily then, just write an email and say, guys, please withdraw that 500,000 and send it to my account, and they'll send the money to your account. So it really depends on why you're saving. But for me, I would say really evaluate, if you've chosen land as your saving way, really evaluate it closely to understand whether it's the right and the best place for you to save, versus also the return that you will get. So I'm hoping I've answered that question, Simon. Okay. So I think the second bit is on building and controlling debt. So here we'll really go through good and bad credit, and using, again, very simple and well illustrated examples for us to be able to understand. So if saving is deciding to put money away and not spend it today, then debt is basically taking money from the future and using it today. So if you want to take a car loan as an example, what happens is the bank gives you 1 million. So you're kind of taking money from your future and then saying, I want to enjoy me driving my car today. So what that means is the bank gives you money from the future, but wants you to pay them in small bits and pieces for you to be able to enjoy the pleasure of driving your car starting today. So how should you use debt strategically? So if you remember last week, we went through this. We went through the one most important number that you need to do and challenge yourself is your net worth. And your net worth is basically your assets. So you take up the assets that really have a value and you can be able to sell. So this could be like if you have a car, if you have a phone, if you have some land somewhere, if you have things that are of value, then you add them up. And then you deduct your liabilities, which would be like, any loans you owe, any rent that you've not paid, you deduct those liabilities. And at the end of it all, you remain with what is called your net worth. And using the same example, we use different scenarios. So say, for example, you buy a car on loan, your net worth could remain the same. If you take an unsecured loan and not use it for the right purpose, then your net worth could decrease. And if you take a loan to, say, for example, buy some stocks, your net worth could either increase or decrease depending on how the value of the stocks perform as well. So when you look at this, you then see where credit really comes to play in terms of your net worth. If you use credit in the most strategic and in the best way, it will really help you grow your net worth. But if you take credit to fund your lifestyle, and not properly planning it out, then the credit will really hurt your net worth. So that said, debt should really be used to buy asset and to increase your net worth. and it should not be used to finance lifestyle gaps. So let's say, for example, after you did your budget and you've tried to cut as much as possible, you still discover that you have a budget deficit. So if you use a loan to be able to fill your budget deficit, then your net worth will really come down because you've not really used that debt to get any assets for yourself. You've simply used it to consume more goods for yourself. So we should really aim to really have good debt only. And good debt is, for example, you take out a loan to buy some land, to buy a house, because at the end of the day, you end up with an asset, and at the same time, you do owe some liabilities. But if you balance them out cleverly, then your net worth will be positive. You can take debt to fund stuff like your education, because if you grow your education today, you can increase your salary. You can take out a loan to start a business. But here, business, I say it very cautiously, because a lot of businesses usually end up not working out, especially if they're not planned well. But if the business is well planned out, it's very easy for you to then use credit to finance the growth of your business. And then lastly, you can use debt to invest. You can, if you cleverly plan out things, you can be able to find a way in which you can take out a loan or some form of cheap debt and then use it to fund investment, and then basically use the returns from your investment to pay back the loan. And then in terms of bad debt, so this could be stuff like car loan. Most of the time, car loans are bad debts because a car is a depreciating asset, and we'll look at car loans in detail. Then you could have a credit card as well. Credit card is also bad debt because credit cards most of the time are used to fund their lifestyle purchases and things that you really don't need to buy. And then mobile loans or digital loans are also not very good debt. Actually, one statistic that's usually very shocking about mobile loans is that the highest number of applications for mobile loans usually come between 12 a.m. and 3 a.m. And usually the location of people when they're taking those loans is they're out with their friends drinking. Whatever cash they had in their pockets, they've used all of it, and they're then stuck and have to think about taking a quick loan for you to be able to pay the bill that you've really incurred at that point. So it's not really wise for most people when they're taking mobile loans. And then lastly, we have cash advances and quick loans, and these usually are not good debt. So in terms of good debt, it helps you grow your net worth. It is usually within your budget and planned out, and the interest rate on good debt is usually not very high. For bad debt, it funds lifestyle. So as I mentioned, you want your friends to know that you drive a good car. You want to be able to afford the latest shoes, the latest handbags. Of course, some people would use credit cards to fund those. And then it's not usually planned and it's not within the budget. A good example is the one I was talking about of if you're out with your friends, you need to be able to continue drinking. So rather than taking the tough decision to say, I'm done for today, let me go home, you decide, let me take out a loan, a Fuliza, for me to be able to afford to buy another round. And they usually, bad debt can also be backed by a depreciating asset. So that's that for good versus bad debt. So what do we do to then control debt? Yep. And I think the quote here that we have, which is when you don't have debt, your money can do anything you want it to, I think is really powerful to show why it's important for us to control debt. And we'll go through detailed examples for the different types of debt for us to be able to see how you can control it. So again, you might have seen this slide, but again, just reiterating the same thing. So there's two methods for you to clear your debt. So any debt that you have, try as much as possible and plan for you to clear it within the next 3 years, unless it's a long-term debt, like for example, a mortgage, which is usually very hard for you to clear within 3 years. But there's two ways for you to clear debt. One is to pay off your debt completely. So this is where you basically use annually. So based on this, you would then pay off the loan using the sequence of number 2, which is the one with the highest interest rate. And then after you clear number 2, you will take, if the mobile loan you are paying 5,000, you will add the 5,000 to your credit card. Then you clear your credit card. And then lastly, you pay off number 3, which is your car loan, which is at about 14% annually. Then on the other hand, we have what is called the Snowball Method. So in the Snowball Method, we have a credit card loan. Again, the same loan, about 10K and about 1.5% monthly interest. You have a mobile loan of about 50K, and then you have a car loan of about 100K. So based on the Snowball Method, what it usually says is that you simply pay off the loan based on the size of the loan. So in this case, you would say, start off with the smallest loan, which would be the credit card at about 10K, which is 10K. You would then finish off paying the credit card, then come and pay the mobile loan, which is 50K, and then lastly pay off the car loan, which is 100K. So, what should really make you choose one method versus the other? So, two factors that we should consider. Number one is how much interest you're likely to pay on each of the loans. And then number two is the time value of money, which we went through in last week's session. So if you do consider the interest that you pay, you see the small interest the small loans. So for example, the mobile loan, which looks like it's 3% monthly. Once you annualize that interest rate, you come to find that it's about 42.5%, which is very high. So the interest that you're paying on that loan is really, really, really high. And in terms of time value of money, the faster you can clear the high interest loans, then it's very likely that you'll be able to clear the other loans that are not growing in terms of interest as fast as the ones with the high interest. So once we take those two factors into consideration, what we find is that the avalanche method is slightly better than the snowball method. So if you have loans, the challenge I would give to you is, put a table down and say, I have this loan, this is how much I owe, and this is how much I'm paying in interest. And based on that, then decide to start off with the loan with the highest interest rate. If you can be able to find an extra 2K, an extra 3K, it will really help you to lower your finish your loan much faster. And then once you pay off, say for example, you decide to pay off the mobile loan, the initial amount you're paying on the mobile loan was 5K, and then you have an extra 2K that you had put on the mobile loan, then you can say, let me take this 7 and then put it into the credit card. So if you are paying 10K for the credit card before, you then end up paying 10 plus 7, which is now 17,000. And then after you're done with the credit card, then everything that you are paying for each of these loans, then put it into the car loan and use it to pay the car loan much faster. That will really go a long way in terms of helping you clear your debts. Then another method for you to control debt is what is called debt consolidation. So you could easily have several debts. Example here, you could have a credit card, about 50K on the credit card, and it's charging you about 18% per year. You could have an unsecured loan, maybe to 50K, 13% per year. You could have a credit card, a second credit card, which is about 75K at 22% per year. And lastly, you could have a car loan of about 1 million, and you're paying about 14% per year for that. So you could decide to negotiate with a bank, or another financier to give you a loan with a slightly lower interest rate. So a good example here is you could decide to take out one big loan of 1.375 million that you pay 13.5% per year, and you clear all these small loans, and you're left with this one big loan for 1.375 million shillings that you then pay off on a smaller, on a monthly basis. And this will really go a long way. So you won't pay the 22 and the 18% interest rate for the credit card. You really have brought down how much you're paying in terms of interest. So in some cases, it really makes sense for you to consolidate loans and have one big loan that you pay a slightly lower interest rate on it. So in terms of controlling debt, what are the final tips? So be careful about late payments and other charges. So here we've not really talked about Other charges that would be levied by the bank, there could be like negotiation fees, there could be late payment fees, there could be annual fees that are charged. So be careful about those and make sure that you know what the full contract is before you take out a loan. Make sure you know how to convert from monthly interest rates to annual interest rates. A lot of, especially the digital loans, they really change it to what they call facility fees or monthly fees or stuff like that. But if you really change those from monthly to annual rates, you'd see that you're really paying a very high interest on these loans. And you don't really have to be a scientist to know how to do it. If you just go online and search, um, convert monthly interest to annual interest, just for example, as a keyword, you will get a lot of websites that will help you to know how to convert monthly interest rates to annual interest rates. And then lastly, um, increase your debt repayment. No matter how small, you can be able to squeeze yourself. Increase your debt repayment if you can as early as possible, and this will help you to clear your loan. An example is especially for credit card debt, which we'll go through in the next little bit. Okay, so just 3 parts left, just 3 examples. We'll go through credit cards, we'll go through car loans, and we'll go through mortgages, just very briefly and very top line. So I just wanted to check in case there's any question, anything that's not clear, and just to check that we are all together before we proceed. Any question on how to build debt, good versus bad debt? Any thoughts, any questions? Yes, Caroline? Okay. Just checking we are together and we're able to follow. Okay, so I can see 2 people have said we are together, that we are following, so thanks for that. I guess we'll continue to the next place, which will look at credit cards, and we'll look at car loans and mortgages in a bit more detail. So in terms of credit cards, how credit cards work, so credit cards are basically what are called revolving debt. So what that means is today you could have a credit card and your bank limit is 50,000 bob. And then today being the beginning of the month, this whole month you end up spending about 40K. So before you make any payment this month, your limit drops from 50K to 40K. So that means your limit becomes 10,000 bob. And if you, after you make your payment, maybe this month's payment, you just pay back 5K, then your balance at the end of the month or your limit at the end of the month becomes 15K. So you can see how your limit really changes depending on how you spend versus how you pay. And you can always be able to spend, for example, in this example, next month you would have an extra 15K as your limit to spend, because you still didn't use 10K last month and you paid back 5K. So they've really given you back your 5, and they've given you the 10 that you hadn't spent last month. So you have 15 to spend. So the big issue with credit cards is that them being revolving debt, it's very easy for you to be in debt forever, because you keep paying, you keep getting, your limit keeps increasing, you keep spending, you keep paying, you keep spending, you keep paying. And as a result of that, you could easily be in debt forever. And that's why banks really try to encourage people to get credit cards. They try to entice you with a lot of nice things like free annual fees and the like, because when you're in a credit card and you're in a revolving debt, it's very easy, and they can be able to keep you within the debt loop forever. So that's why it's important to be careful about credit cards. So for credit cards, it's important for you to understand your interest-free period and try to stick to it as much as possible. So a lot of times banks offer, say for example, a 25-day interest-free period or a 50-day interest-free period. It's important to understand how that works, and I'll show you with an example. And then for Credit cards, make sure you pay off using a fixed monthly amount and do not rely on what the bank is telling you as the minimum that you should pay. And I'll also show an example for that. So to start off with the first example, where we want to look at the interest-free period. So what happens is you have a credit card. On the first, you spend about 10K. On the 15th, you spend about another 10,000. And on the 25th, you spend another 10,000. So in total, you spend 30,000 out of, say, a limit of about 50K. Then the bank tells you you have 50 interest-free days. If you look at it in most cases, when they say that they give you 50 interest-free days, there will usually be a very small asterisk at the top. What that asterisk means is that it's not 50 on everything it's not 50 on 50 days on everything. Usually it's 50 days, which is 30 for the month and then 20 for the next month. So that means if your limit is 50K at the beginning of the month and you spend your 50 on the first of the month, if you pay that 50K by the 20th of the next month, then you will not pay interest. But if you spend, towards the end of the month, then of course the interest-free period is much lower. So using this same example, the spend that you made on the first will have 50 days of interest-free. The spend that you made on the 15th will have 35 days interest-free because 15 have already passed. The spend on the 25th will have 25 days interest-free. And that's how it usually works in terms of the interest-free days. Then let's look at two examples of why, especially with credit card, it's important for you to pay using a fixed amount rather than paying off using a decreasing amount. So let's take an example of these two ladies, both of them with credit card debt of about 50,000 bob. Their interest rate is the same, it's 13%. But then on the case of Jen, what you find is that her monthly payment is 500 bob, but then it's reducing every month because the bank basically tells you today pay 500, and then next month they'll tell you to pay 490, and then the next month they'll tell you to pay 450 and then 400. It basically continues decreasing as the months go. So in the case of Jane on the left-hand side, what happens is she'll take much longer to finish paying off her loan. So in this case, she'll take 25 months. And the interest that she'll have paid in total will be about 5,200 shillings because she's paying off over a slightly longer period of time. On the right-hand side, we have Joy. And Joy basically has, again, a 50K credit card, about 13% interest rate, and she's paying 500 bob equally for every month. So in this case, what happens is she will take 11 months to pay off her loan, and the total interest that she'll have paid will be about 3,214. So there's a saving of about 2K in interest just because of Joy deciding that she will pay off the same amount every month and not rely on the bank telling her to pay off what is the minimum, because the bank will basically structure the minimum to keep you in the debt for longer. Remember when I said that credit cards are basically revolving debts and they want you to keep being in the debt so that they can make as much money from you as possible. Okay, so the second one is car loans. Just have one slide to illustrate car loans. So take an example of this guy. We like calling him Jordan. So basically Jordan takes out a car loan of about 1 million shillings, which you can see there as the black bar. So that's the purchase price of the car. And then the yellow bar is basically the interest that he pays for the year and the year before. So for example, in year one, he pays 130K in interest. In year two, together with year one, the interest that he'll have paid will be 239K. And by the time he gets to year five, he will have paid back 1.396 million shillings, which you can see at the very far right. So that's the total that he'll have paid back to the bank. But then, like we said, a bank, just checking if you can still hear me. You can see the screen has gone off. Let me just put back the screen. Give me 1 second. Okay, the screen should be back now. So hopefully you can be able to see it on your end as well. So as I was mentioning, so he bought a car for 1 million bob. He, by the end of year 5, he'll have paid back the bank about 1.396 million, which is about 1.4 million that he'll have paid back to the bank. Then in terms of the value of the car, so of course we know cars are depreciating assets, so the value does not remain the same, the value goes down. So using this same example, the value of a car goes down by about 10% every year. So he bought the car for 1 million. At the end of year 1, the car is worth 900K, but he will have paid the bank 1.1 million in case he clears the loan by year 1. If he clears the loan by year 2, he'll have paid the bank about 1.2 million, and his car will be worth 810. By the time it gets to year 5, he'll have paid the bank 1.4 million, but he can only recoup about 600,000, just slightly less, about 590,000, if he pays, if he sells off his car. So you can definitely see how tough it is, especially for car loans, and we really have to be careful with car loans because unless you really need it, it's usually one of those loans that is bad debt because whatever you pay back as interest, for example, in this example, you pay back to the bank 1.4 million, but you only get 590K in terms of a value from the car. So, what are the important considerations when you're taking car loans? Number 1 is that preferably only take a car loan if the car is a tool of trade. That means it's required by your work or by your employer, and your employer gives you a good scheme on the car loan. Usually that's the best way. And if you're taking the car to be a means of transport, really consider getting a not so expensive model. Just get a car that will get you from point A to point B safely and efficiently. So I'm not saying buy a bad car that will keep breaking down on the road. Of course, that's why I'm talking about picking a safe car. But then also fuel efficiency is important because cars are very expensive to run, both from a fuel and a maintenance perspective. So it's important for you to make sure that you choose a car wisely, and knowing that they are depreciating assets, then really choose how to finance it best so that you don't end up paying too much in interest. Then the last bit is on mortgages. So for mortgages, basically, so using this same example, we have our guy here is called Jordan. He takes about 10 million out from the bank to buy his home, and at about 14% interest. So the cost of the house is 10 million, but he's able to pay a down payment of 500K from his savings. So that means the mortgage amount that he actually takes is about 9.5 million, whatever he borrows from the bank. So when the bank does their calculation, they tell Jordan to pay 107,000 shillings every month. And then, he's given 30 years for him to pay the mortgage. So by the end of those 30 years, he will have paid interest worth 22.6 million. And if you add the principal back, which is the 9.5 million that he owed to the bank, you will find that Jordan, in this case, will have paid to the bank almost 32.1 million from the 9.5 that he took out as a mortgage. And then in mortgages, there are also other costs that usually are there when you're buying a home. So there's like stamp duty, which is about 4%. There's legal fees of about 3 to 5%, and there's also other costs that are involved when you're buying a home. So if these costs are also part of your mortgage, of course, your interest, your monthly repayment will be much higher depending on how you've structured your loan. But then this is where the power of really increasing your repayment comes. And using the same example of our guy Jordan here. So remember, the bank asked him to pay 107 every month. And then Jordan says, or he goes negotiates with his employer and gets an extra 10K in terms of an increment for him on his salary. So as a result of that, Jordan is able to pay 117,000 religiously every month. So if over the same period, of course, it won't take him 30 years for him to pay back. It will take him slightly shorter because he's paying an extra 10K every month. So in this example, what you find is that Jordan will in this case pay interest of about 13.4 million. And if you remember previously, the interest was 22.6. So this has gone down to almost half to about 13.4. And then his total payments has also gone down from 32 million all the way to 22.9 million. So you can see, in as much as he's paying a very small incremental amount, which is 10,000 bob, you can see how the impact is over time because of the factor of compound interest. So depending on, especially loans, considering their long-term loans, whatever extra you can be able to pay to the bank, please put money extra to paying off your loan, and it will have a very big impact in terms of helping you clear the loan much faster. So tips on mortgages, be very careful. These are basically long-term loans, and similar to the example that we've shown there for Jordan, very small changes in monthly payments can have a great impact on the total interest and the payments that you make. And then secondly, you need to balance out the costs to ensure that other costs that are involved, like stamp duty, legal fees, negotiation fees, and the like, are not really added to the cost of the loan, because that will make the loan become more expensive. So just a recap on the debt section as we come to the end of today's class. So debt is basically, you need to use credit strategically. So when debt is used responsibly, it can really help you improve your overall financial picture and your net worth. So make sure you use debt strategically. Make sure you control debt. Remember, we've shown you the avalanche method that you can use to pay off your debt faster. And consider using debt consolidation in case you have lots of debt, for you to be able to clear paying off your debt. And then in terms of types of debt, so only take good debt and make sure that you understand the debt types in detail for you to be able to pay the least interest possible. So just ending today's class with this quote that basically says, happiness is letting go of what you think life should really be like. So if you're always chasing a better dream, a better car, a better house, it's very hard to be happy. But if you just let life flow and take some of these rules and apply them, then you'll have a lot more happiness in your life. So that's it from me. Thank you. You have been an awesome audience. So I don't know if there's any questions or any person with anything they want a clarification or anything for next week's class. So next week's class is basically on investing, and we'll go through how to invest and where to invest a bit more in detail. Okay, I'm just checking if there's any question. I can't see any in the chat box, but if there's anybody with a question, please feel free to unmute yourself, or feel free to ask in the chat box. So Genevieve, you're saying, wow, amazing session indeed. Thank you very much. That's amazing feedback. Yes, Caroline, did you have a question?
Yes, I have a question. You've said which is the best institution we can start saving on money market?
So for me, I would say go with a company that has been there for a while, and as well has been is one of the top companies in terms of money market. So for me, I would advise go with CIC. I'm not affiliated to them, or I don't get any commission from them, but I do save with them, and I've been happy with them so far. So that's why I'm recommending them.
And the minimum someone can start with is 500 shillings.
I think the minimum is 1,000, but I mean, in terms of opening the account, but then you can top up 500 every month at the minimum.
Okay.
Okay, I can see Ruth's. Yep. Did you have any other question, Caroline?
No.
Cool. Thank you. I can see Ruth as well saying, wow, I'm more informed on debts. You're very welcome, Ruth. I don't know if there's any other question. Again, feel free to unmute, feel free to ask, or if there's something you want to see in next week's session. John, thanks as well. You're saying very interesting session. You are most welcome. Okay, so thank you very much, everyone. I'm just posting a link to our webinar that we have tomorrow, just in case you've not registered. So this webinar will be tomorrow at 6. If you go to the link, you'll be able to get a bit more information on the webinar, just what to expect. And if you're interested, please feel free to fill the form there, and we'll remind you tomorrow when it comes to time for the webinar. And thank you very much. You have been an amazing audience. So I can see Stacy has a question before we go. So Stacy is asking, in regarding to stocks, which one would you advise one to buy for a first-time investor? That's brilliant. So Stacy, I think allow me to tackle that in next week's class, because it's part of the things that we'll talk about next week when we talk about investing. So we'll go through details of stocks, how to evaluate the right stocks for you to buy, and we'll go through that in a lot more detail next week. Okay, thank you. Thank you as well. All right, so thanks everyone. You've been an awesome audience, and do have yourselves a great evening.